This stock went public at $88 a share. 18 months later, it had lost around three-quarters of its value, all the way down to $19. Most investors wrote it off for dead. So why has it quietly nearly doubled off that low, and why is it suddenly one of the most interesting turnaround stories on the market? It's Ibotta. You probably know it as the cashback app on your phone. But underneath that app, it has quietly built something far more valuable, an advertising network that now reaches over 200 million shoppers. So here's the question. Is this a real comeback? A beaten-down platform that's finally re-accelerating? Or is it a value trap, a broken IPO that simply bounced, dressed up to look like a turnaround? The answer comes down to one number most people completely miss. Stick around, because part 2 is the risk that could sink the whole story. Ibotta is a small company, worth only around $900 million. That's a fraction of the giants we usually cover. We'll run this in 3 parts. Why it might be a genuine comeback, why it might be a trap, and the chart. Then a verdict, and the one metric that settles it. Let's start with the bull case, because something real just changed. 1. Growth is back. Last quarter, revenue grew 3% from a year ago. That might sound small, but here's why it matters. It was the company's first quarter of growth in over a year. The decline has stopped, and it happened ahead of schedule, beating the company's own guidance. 2. And this is the whole thesis. The network. Forget the app for a second. Ibotta's real prize is what it calls the Ibotta Performance Network, its answer to retail media. Instead of just paying users cash back inside its own app, Ibotta now powers the cashback offers you see inside other companies' apps, at Walmart, at Dollar General, at Instacart, and now a brand new deal with 7-Eleven. And that network piece is growing fast. Revenue from these third-party partners jumped 27%. That is the part that can scale. 3. The setup is unusual. This is a small, roughly $900 million company that is actually profitable on an adjusted basis, riding one of the fastest-growing corners of all of advertising, retail media. If that network keeps compounding, a company this size has a long way it could run. Growth returning, a real advertising network scaling underneath the app, and a small, profitable base. So what's the catch? The catch is that this comeback is still young, and it is fragile. Here's the first problem. That return to growth, it was 3%. After more than a year of decline, the business is barely growing again. This is the very beginning of a turnaround, not a proven one. One weak quarter and the whole story is back in doubt. Second, and this is the big one, concentration. A huge share of Ibotta's business flows through a handful of giant partners, Walmart above all. When one enormous partner shifts the timing of its promotions, it can swing an entire quarter for Ibotta. That's not a stable, predictable base. It's a dependency, and it cuts both ways. Third, growth is coming at a cost. While revenue ticked up, the company's adjusted profit actually slipped, down about 7% from a year ago, and it still loses money on a bottom-line reported basis. So it's spending to win this growth back. And one more thing. Remember, the stock has already nearly doubled off its lows. It's now trading close to its 52-week high. A lot of the good news from this turnaround may already be in the price. In fact, the average analyst rates it just a hold. So here's the scorecard. On one side, growth has returned. The network business is scaling 27%. It reaches 200 million shoppers, and it's a small company with room to grow. On the other, total growth is only 3%. It's heavily dependent on a few giant partners. Adjusted profit is slipping, and the stock has already run back near its highs. A real comeback, or a trap that's already bounced. For the tiebreaker, we go to the chart. Fundamentals tell you what, technicals tell you when, and Ibotta's chart tells the whole emotional story of this stock in one picture. From an $88 IPO, it collapsed all the way to around $19. Then, quietly, it began to climb, and it has powered back to near $38. So right now, it's sitting close to the top of its 52-week range, which runs from about 19 at the low to just over 40 at the high. Momentum is strong. This has been a steady, powerful recovery. But that also means the stock is now bumping right up against resistance, the same highs it's struggling to clear, the levels that matter. On the upside, the big one is the 52-week high, just above $40. That's the ceiling. A clean break above it would signal the recovery is entering a new phase. On the downside, there's support down in the low 30s, and below that, the gap near the high 20s where this last leg began. Lose those, and the comeback loses its momentum. So the chart says, a powerful recovery, now testing the ceiling. What happens at that $40 high likely decides the next big move. So, a real comeback or a trap that's already bounced? Here's the honest framework. The bull case is genuinely intriguing. Underneath a boring cashback app, Ibotta is quietly becoming the infrastructure of digital promotions, the network that powers cashback for some of the biggest retailers in the country. And that specific piece is compounding fast. For a $900 million company, that is a real asymmetric opportunity. But the bear case is just as simple. Strip away the network story, and you still have a business growing only 3% overall, leaning heavily on a single giant customer with profits slipping and a stock that has already sprinted back near its highs. The exciting part is small. The risky part is big. Which brings us to the one metric that settles the entire debate. The growth of that third-party network. Not total revenue, that number is muddied by the legacy app and by Walmart's timing. Watch the growth of the Ibotta Performance Network, the third-party publisher revenue. That single line tells you whether Ibotta is truly becoming a scalable advertising platform or whether it's still just a cashback app that depends on one giant retailer. As long as that network number keeps compounding at 20% or more, the comeback is real. The quarter it slows toward the flat, low single-digit rate of the overall company, the trap is closing. Pair continued 20% plus network growth with a clean break above that $40 high, and the bulls have their confirmation. Until then, Ibotta is a fascinating high-risk turnaround, a genuinely promising network hiding inside a fragile, concentrated business at a price that already assumes the comeback works. A small stock to understand completely before you ever touch it. That's the full breakdown, the crash, the network, the concentration risk, and the why behind all of it. If this helped Ibotta finally make sense, subscribe. Every week, we break down one company on Wall Street exactly like this, so you can invest with a framework instead of a feeling. The free breakdown sheet, with all the numbers, is linked in the description. Quick but important. This channel is for education and analysis only. It is not financial advice, and I'm not your financial advisor. Do your own research or talk to a licensed professional before investing a single dollar. What company should we break down next? Drop the ticker in the comments. See you in the next one.